Hello traders, Gary Wagner here, just about noon in Honolulu. 6 o'clock in New York, it is Friday. Happy Aloha Friday, as we say on the islands, September 29th, 2017, and this is the Daily Report for Gold and Silver, our weekend review. This is a weekend review, a month-end review, and actually the end of the quarter as September comes to a close this weekend. Gold traded lower on the week, traded lower on the month, and on the day, capping off today's activity down about $6.40, closing at $12.8230. 1280 is a critical number. We will talk about that as we look at our technical studies. Silver also trading lower on the day. That was off about 18 cents at $16.66 an ounce. That all in light of a fractionally lower, I'll call it a fractionally unchanged dollar today at 92.89. As we wrap up this month and this quarter, it is quite obvious that over this last month, we have seen tremendous pressure on both gold and silver pricing. A more hawkish stance from the Federal Reserve and the net result of a stronger dollar has put significant pressure on gold as well as silver. So for that reason, I do want to start today's show by looking at the dollar index both through a daily and a weekly chart. The first thing that we do want to look at is over the last 3 trading days. When we look at our daily candlestick chart of the dollar index, we can clearly see that for the first time in quite some time, prices have now closed above its 50-day moving average. And we really need to compress this chart to see how long it has been since this trend has been intact. We had tremendous pressure. This, of course, is the beginning of the year here, and we did have the dollar index trading well above its 50-day moving average, but then breaking below it at the start of 2017. And aside from a couple of quick blips above that, we can see that the dollar has remained under pressure for the better part of this year. That is up until the last 3 trading days. And traders, when we convert our daily chart into a weekly chart, it becomes even more clear how dynamic this most recent move in the dollar has been. We are now at a point in which we can say that over the 3 last consecutive weeks, we have seen higher pricing in the dollar index, and some real support came into the market after touching upon these lows at the end of August, beginning of September, when the index reached 91. And of course, we can see the opposite reaction in gold pricing. We are looking at a weekly chart in standard candlestick format, and it is easy to see that over the last 3 weeks, we have seen consecutive lower closes on the week. But what is more interesting to me is the current price point as it relates to our Fibonacci retracement. And to that end, I've pulled up a daily candlestick chart with our Fibonacci retracement as well as our Elliott wave, because the two do go hand in hand. And the way that our current count is running is that we had our first leg of the rally, our wave 1, as the market traded from approximately 1200 up to 1280. From there, we had a 23% retracement, which took us to 1256 and was the beginning of our longest wave, which is our wave 3, roughly a $100 plus rally, culminating at the yearly high of 1363. Now, obviously, since we hit that yearly high back at the second week of September, we've seen a slow and methodical decline, culminating with today's moderate sell-off, $6 lower at $12.82. During this course of declining prices, we did take a couple of stabs in the market, and the last one that we took was when the market came and tested the 61.8% retracement, and we had this little bounce. That, of course, occurred at the beginning of the week. That, traders, in fact, was a false breakout in that we saw the market give back not only price gains from the beginning of the week, but move into more negative territory in which we saw prices culminate with a low over the last 2 days, which corresponds precisely to a 78% retracement. And traders, it is my current belief that if not here, where? In other words, this is a very logical price point for us to look for some support to enter the market, for this current correction to conclude, and for gold prices to return back to a rally mode. However, until we have strong technical confirmation that a pivot or key reversal has occurred, we are going to sit on the sidelines, but I do believe that we should see the market bottom sometime over the next week or two. Therefore, my recommendation is to maintain our current neutral stance in the market and await our next signal. Traders, as this month and quarter come to a close, it's interesting in that we've seen dramatic drawdowns or a correction that has been fully in place over this last month. But when we look at the performance over this last quarter, we actually have a net gain of about 3%, which is precisely the same net gain of the Standard & Poor's 500. In fact, as I said in my opening letter, if you go back in time, we can see a 20% gain in both equities, S&P 500, as well as gold. So there's something interesting going on here. My sense is that we have seen this correction hit a bottom, and now we are simply waiting for a base to form. And once we have confirmation that a base is formed and have an indicator that tells us we are witnessing a key reversal, we will issue our next trade recommendation. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.